In part one of this exam, we've got a financial model with income statement, balance sheet, cash flow statement. We've got some actual numbers, some projected numbers. It looks like we're going to have to calculate some ratios, talk about return on equity and other things. So this model looks like it's already all completed. Balance sheet balances. We've got sales growth inputs, balance sheet inputs. That's all hard-coded. Let's get to the first question. Calculate the current ratio in the model output table for years 2022 through, I think this should be 2025. And would you say the company has sufficient liquidity? Okay, let's calculate current ratio. So current ratio is current assets divided by current liabilities. Current assets are cash plus inventories, in this case, divided by current liabilities. In this case, it's just accounts payable. So we can all leave that there. It's already formatted as multiple, so that's fine. Sure, we can control write this, the current ratio of 6 and actually increasing to 10. Yes, this company has sufficient liquidity, and actually its liquidity position is improving. Question 2, calculate equity multiplier, asset turnover, profit margin, return on equity. All right, so let's do that. Equity multiplier. So in equity multiplier, we need total assets divided by total equity, or rather average assets divided by average equity. So we'll do average and average assets of last 2 years. So this is going to be this number and that number divided by average of shareholder equity. And shareholder equity, we don't have one number, but we have common stock and retained earnings make up shareholder equity. So we'll need to take average of this number plus this number and this number plus this number. Okay, and that's going to be the equity multiplier. Asset turnover is going to be sales divided by average assets. So it's going to be end of the year assets are here, and beginning of the year assets over here. Perfect. Profit margin is just net income divided by sales. That works just fine. And return on equity is going to be net income divided by average of equity. The beginning of the year and the end of the year, which is the average of this number plus that number. That's the equity at the end of the year. And I'm going to average that with the equity at the beginning of the year, just this number plus that number. All right, and this gives me return on equity. Fantastic. Let's control that right. And we've got our ratios. Let's check that the DuPont identity holds. Let's actually do that down here. That would be the product of equity multiplier, asset turnover, and profit margin should add up to the return on equity, and it does. Fantastic. Why is the return on equity declining? So because we have all the components of the DuPont identity, we can actually identify what is the source of the decline in the return on equity. You could see that it's not profit margin. Profit margin is the same. Net income is the same, and revenue is the same. So that's not the problem. Asset turnover is definitely declining. So that's one source of that decline in a return on equity. Equity multiplier also remains roughly constant. What drives the asset turnover decline? Well, we know that revenue remains constant. There's nothing happening on revenue, but assets are increasing. Assets going from 146 to 188. The assets are increasing not because they're building PP&E or because they're building inventories. Assets are increasing because they're accumulating cash. So really this cash accumulation is the source of the decline in return on equity. There's just too much of retained earnings on the balance sheet. The firm is operating in a highly competitive market. What changes should the firm make to increase its return on equity? Well, it really needs to increase its asset turnover. It needs to decrease the shareholder equity on the balance sheet. And it can do that by increasing the dividend payout, or it can buy back some stocks. Why is the firm cash flow so much lower in 2023 than in 2022? Well, let's take a look. So here's the cash flow. In this row, we see cash flow. It's always positive. Every year they're increasing their cash position. But in 2023, the increase was only $9 instead of $18. Why is that? Well, the net cash provided by operating activities went down by $5. Why did it go down? It went down because they added $5 worth of inventories. And we can see that on the balance sheet that inventories went up by $5. That's a use of cash. So that's definitely part of the decline in cash flow. But there's also a decline in cash flow from financing activities. So it went from -10 to -14, which is driven by the increase in dividends. And they increased dividends because the dividend rate payout went up. It went up by 50%. So that's why the cash flow was much lower in 2023 than in 2022. Certainly, if you'd like to see those answers written out, check out the file, and you can see all this calculated and written out. Part 1, question 6. What do we have? So we have the same model. Everything looks the same as before, but now instead of modeling depreciation as % of sales in the projected years, model it as a % of previous year's PP&E. Set the percentage to 10%. So right now, depreciation is modeled as % of sales, but we're going to model it as % of previous year PP and E. The rationale for that might be that because the machines depreciate, and how much depreciation we have depends on how many machines, how much PP&E we have, and they told us to set that at 10%. So we're going to set it at 10%. But of course, if I just set this at 10%, the depreciation is still calculated as 10% times revenue, and I need to change that. I needed it to be 10% times the previous year PP&E, or rather beginning of the year PP&E. So it's right here. and I can Control R that over here. And what I see is that now instead of having depreciation being $10, it's only $8. What happened to the firm? The firm clearly became more profitable because now if there's a less wear and tear, at least as far as accounting profit is concerned, the net income is higher. You can quickly see that going back here. We had net income 28. Now we have a net income of 29. So the firm is more profitable. The PP&E is actually now going up, the net PP&E, because if we recognize less wear and tear, then the book value of PP&E is actually going up. All right, very good. So that's part one of this exam. Let's do part two. What do we have here? Okay, so we have a Lego. Who doesn't like Legos? And they plan to build their first US factory in Virginia. The cost is 900 million. The construction spread evenly across 3 years. Production will commence in 2024 with sales starting at 200. Operating costs at 100, both revenue and operating costs grow at 5%. There's some depreciation over 10 years. Factory lasts to 2023, at which point it will have zero salvage value, 30% tax rate. All right, 10% discount rate. So let's create a setup. So let's start over here with year 2022, and let's increase that by 1, and we want to go all the way to 2043. So we actually don't need all the way to here. Can delete that. Perfect. What numbers will we need? Well, we'll certainly need revenue, and revenue begins in 2024 at 200, and it will grow at 5%. So we're going to multiply that by 1.05. Oops, 1.05. Right, that would be 210. We can Control write that all the way here, and we see that the value of sales in 2043 is $505 million roughly. So I can actually link that. Actually, let me link it here. That's the answer to question 1. What else do we need to do? We'll need to calculate income and income before taxes. So because it asks when will Lego start paying taxes. So let's put in operating costs. We know that those operating costs are going to start at also 100. We're going to assume that those operating costs begin only in 2024 because that's when production commences, and can really just copy that cell and multiply it by 5%, and we'll get our operating costs growing, starting at 100 million, growing at 5% per year. What else do we need? Well, we need depreciation expense, and the depreciation. Well, so look, so they're starting to build the factory in 2022. We can assume that they'll start claiming depreciation expense as soon as they start building the factory. If you instead start depreciation expense in 2024, that's fine too, but let's assume we'll take the depreciation expense as soon as we can. So if we already have some factory built in 2022, let's claim a depreciation expense. It's going to be depreciated over. Oh yeah, actually, I said in the question that the depreciation starts in 2022. So there's no ambiguity there. And it's going to be depreciated over 10 years. So we've got $900 million factory over 10 years. The annual depreciation is going to be $90. And for the next 10 years, it's going to go to 2031. Once we're here, we can calculate income for taxes. That's going to be revenue minus operating costs minus depreciation expense. And we can control write that all the way. We can calculate taxes. Now, taxes are going to be 30% of non-zero income before taxes. We'll need to wrap our function into the max function. It's going to be either 0 or it will be income before taxes times 0.3. So in this case, it's the first year it's 0 because they don't make any income. But by 2024, they're going to start paying taxes because they have their income before taxes is going to be $10. And actually makes sense because they're going to make a gross profit of 100 minus depreciation expense, still leaves them with income before taxes of 10. Okay. Fantastic. So now we can calculate operating cash flow. Operating cash flow is going to be, and we can just use the top-down method, which means we'll take revenue, and from that we're going to subtract cash expenses, which is the operating costs, and tax, certainly an operating certainly a cash expense. So that's 0 in the first year because we don't have any revenue, we don't have any operating costs. Sure, we have a depreciation expense, but that's non-cash expense. We don't pay any taxes. So operating cash flow in the first 2 years looks like it's going to be 0, but then it's going to hopefully turn positive. Look at that. Here in 2024, the factory generates $97 of operating cash flow. Where does that come from? It comes from basically gross profit of 100 minus taxes of 3 is $97. Now, how about in investment cash flow? Investment cash flow. So we have the factory. So there's a $900 million factory that takes 3 years to build. So we're going to split that cost. And I don't want this to be formatted as a percentage, so I'm going to actually change that control 1. Let's just make it in accounting. No symbol, decimal places. Let's leave it like that. Let's split the 900 million over the first 3 years. So it's going to be minus 300 here and 300 for the next 2 years. That adds up to 900. And after that, there's no other investment cash flow. There's no salvage value. There's no additional investment. This is it. So we can calculate total cash flow associated with this factory, which would be the operating cash flow plus the investment cash flow right there. We can stretch it all the way to 2043. And this is what's going to help us calculate NPV of this project. We know that the first cash flow we have to add manually, and then we're going to do NPV at 10% discount rate. and array of all the remaining cash flow. Oops. It's giving us 81 million. So there's a positive NPV of the factory of 81 million. What is the IRR of the project? Let's ask. It's 11%. Clearly, it's above the discount rate, so this project is a go, both because it has a positive NPV and because the IRR is greater than the discount rate. Fantastic. Then we have some other questions here. We have the accounting board of the state of Virginia decided that LEGO should depreciate the factory over 10 years rather than the standard 30-year. So they've got this shortened depreciation schedule. Do you think this made the investment more attractive for LEGO? In general, the sooner we can claim depreciation, the better, because depreciation expense reduces our income before taxes, and that then reduces our income tax. And so we pay lower taxes now, but of course then we have to pay higher taxes later on because there's no depreciation expense in year 2032. But since we care more about having lower taxes today than lower taxes into the future, and higher cash flow today than higher cash flow in the future, in general, having accelerated depreciation schedule is favorable. It makes the project more attractive. It can get a little complicated if you don't have any tax assets, meaning that some of this early depreciation is wasted because you didn't have any tax liability to begin with. So we'd have to do really a full calculation, but here the tax liability kicks in pretty soon, and so while we would have to do a full-blown calculation to know for sure, the consideration of lowering your tax bill in the early years as makes a shorter depreciation schedule beneficial. Final question. An investor says that the factory should be cut in half. The smaller factory initial sales would be 103 million, initial operating costs 50 million, growth is still 5%. Let's do the calculation. What is it better to cut the factory in half, make it smaller? I'm just gonna control and copy this down below here. We can easily change the parameters. So this will be 103 and this will be 50. The depreciation is going to be not on a $900 million factory, but on a $450 million factory. So it's going to be 45 million. And of course, the investment is going to be lower. It's going to be just negative 150 for the next 3 years. So this is a smaller project. Now we can definitely calculate the IRR of this project, and that's going to give us IRR of all this cash flow. It's 12%. So the investor is correct that this gives us a higher IRR. However, the decision rule that should prevail is which of these two projects has higher NPV. So the NPV of this smaller project is, well, the initial cash flow, we have to hard code, plus NPV at 0.1 discount rate, taking all this remaining cash flow, is going to give us NPV of 64. So and I think that's correct. So the NPV is lower, the IRR is higher, but the NPV is lower. So we shouldn't do this smaller factory. We should do the factory that has a higher NPV value, and that is the bigger factory. We're comparing 81 with the bigger factory to 64 with the smaller factory. Clearly, we are going to add more value to Lego if we go with the bigger factory. We're going to add $81 million of value than with the smaller factory, which adds only 64 million. Even though the IRR is higher on the smaller project, when in doubt, let's use NPV. And that's it. That is for this exam. And let's play some other. All right.